Good afternoon. It is Thursday, June 16th. Happy U.S. Open Thursday too, by the way. This afternoon we're going to talk a little bit of silver as these markets have heated up, the metals specifically. We did talk gold last week. Currently silver for the last few months has been lagging behind gold quite significantly. And this shows by looking at the gold-silver ratio right here over my right shoulder. It is elevated to near 74, and it's been elevated for quite some time. You can see what happens. How this is derived is gold divided by silver. Okay, so gold trading at roughly $1,300 an ounce divided by the current price of silver. That's where 74 comes in. We've seen this several times, in history. I think this is looking at about a 25-year chart right here. It does look like it's rolling over. What that means is silver has some significant catch-up to play, and we could look for that to come, over the next few months. And if it does, in my mind, silver is the most explosive commodity market of all the markets when it starts trending. I don't even know if this is in my mind because I can't think of any market, since I've been doing this off the top of my head, that even comes close to silver. Part of that has to do with the contract specifications. When this contract was designed, silver was trading $5 to $7 an ounce. At a 5,000 ounce contract, that translates to $5,000 per each dollar movement. So you can do the math. It was designed when low volatility was low enough. We're in a low dollar range. That's where we're at. So when it starts getting up here, the chances for volatility, start increasing and picking up pretty significantly too. So managing risk is always priority number one, but especially so in the silver market. Coming up with no signs that the Fed is serious about actually raising rates and global rates continuing to dip negative, the makings of another bull market are certainly there. Patience, I think, will pay off. You want to be careful about lunging, up at these levels. For the bears, I guess, and for the bulls, the one thing to be really concerned with is the commitment of traders, as is the case with gold. Essentially, you can see over my shoulder here, the commercials are historically short on a 10-year chart, and they have been for quite some time. And a lot of the hot money has piled in to this market really since about the beginning of the year. So what happens, I guess, and the reason you want to be cautious is when levels in the commitment of traders at open interest gets extended out to where it's at, it leaves the question to me of who is left to buy this market. So much hot money has chased it. We're already kind of making highs. So as far as buying futures goes, I would be very careful and very cautious about lunging at these levels. For bulls and longs wanting to jump in, I prefer longer dated call spreads by longer dated, and I think September's longer dated in this environment where everything's sort of minute to minute, day by day with what's going to come out with regards to the rates and the global economic uncertainty. September's plenty of time. If you want, December is also available too. Good luck, good trading, and as always, managing risk is key number one. These are my thoughts and not those of ADM Investor Services or Archer Financials. Thank you.